One of the ways that we interact with our clients and try to assess their life insurance needs is using a software that we've spoke about in the past, and you can find it online under our web page under Make a Plan.
Right.
And it's the Asset Map software. So we've got a scenario that we've pulled up using the Asset Map, and this is an example case of a JV quarterback, I guess, for the Tampa Bay Buccaneers, the Tom Grady, not Tom Brady. So he is falling on hard times here and is only making $160,000 a year.
Yeah, so he's a guy in his early to mid 40s, has a wife that stay-at-home wife, stays at home and takes care of his three children, which are age 16, 13, and 3, I believe. Makes a good, a reasonable living, has taken a little bit of initiative and saved in his 401k at work and kept his debt down, has a nice house, $400,000 house with a $300,000 mortgage on it. Nothing too exciting. He's even saved a little bit for his kids' college, about $25,000. So it looks like he's in really good shape, and he is.
And we run into this. Yeah. This is not just, we joke and say Tom Grady, but this is several scenarios.
It's an exact case that I talked with a client of mine just a couple weeks ago.
That's correct.
But if you notice, above Tom and Drizel's heads should be that space is empty, and it should be, that's where the life insurance area goes, or where not just life insurance but insurance period goes.
So exactly. So why would there be a need here? Well, if Tom passed away in this scenario, with his wife not working outside of the home, which she has a full-time job, it's just not paid for it.
Right.
He is the main income winner. So there would be a need for income.
Right.
And if we went through the scenario, if she's not working, many widows, as we've encountered, worry about the house. How am I going to keep the house? Well, in this case, the house is valued at $400,000, but there's a $300,000 note on it.
For sure.
And, then, the biggest asset I see on the screen here is a 401k. Well, if you tap into that, even though she would inherit it, it's going to be taxable. So it's going to be a whole lot less than $350,000, and that's not smart.
If she spends that, she doesn't have anything to retire on.
Exactly. So she's in a situation that we see many times. So debt, obviously it would take something to bury final expenses. Then, as many parents, they would like to provide a portion or all or whatever they've figured out for their education expenses for their kids.
They had planned on helping their kids or paying for all of their kids' college expenses, which many people do. We could have another show on that, but which just a kind of a average estimate expense is $25,000 a year times 3 kids. That's $300,000, right?
That's exactly right. So when we were building out this scenario, and we didn't want to take it line by line,
right?
But we wanted to show on the screen here that hey, this is a normal situation. This is a young couple that have kids with a house, not astronomical debt.
Yeah.
But a normal scenario. So as we ran the numbers, unless you can speak with this too, so we got income replacement. So if she went to work, then she'd probably have to get a nanny or have significant daycare expenses.
Right.
But then at the same time, there would be a transitional income where I've seen in widow cases, either spouse, whichever passed away, people just aren't thinking right in those first few periods of time.
Yeah, there's just there's transportation costs. There's all kinds of things that pop up that you may not know how to handle, whether you're the sole provider or if you're the stay-at-home mom that or the stay-at-home parent that either one of them going out of the picture changes.
It's a traumatic experience,
right.
And that's what I referenced when not thinking right. It's just a traumatic time.
Yeah,
it's a traumatic time, and there's things flying in from everywhere that you may not have dealt, and just scenarios that you want to take care of your kids. and the education expenses, we covered that for the 3 kids. And then also just to have a slush fund of emergency reserves is important. So what we figured out in this scenario, as you ran the numbers.
So, I mean, to fund that, they would need a savings. If they would need to have in a savings account or investment account about $1.8 million today
to be
on top of what they already have to cover all those needs. So, life insurance provides that opportunity at a much smaller cost than saving $1.8 million. Now, this is if Tom were to pass away today.
And as we talk, when we explain life insurance today in their scenario, assuming no significant amount of debt is accumulated after today in this scenario, that over time the assets are going to increase, and today's life insurance need is probably at its greatest. So as debts decrease and assets increase, then the need for life insurance probably isn't as great. But we're solving this picture for today, and this is where a potential term policy could come into play.
Right.
And in a scenario like this, the cheapest insurance for the most amount of death benefit and covering a period of time until the kids are out of school, college, until potential debt's paid off, then, having a life insurance to cover that need today, and many times you may stagger a couple policies, whereas you have a 30-year term or a 20-year term or a 20 and a 15 to cover that period of time.
Right.
And we could get into but the bottom line is there's a significant need here.
Yeah. Well, and I mean, to emphasize that, if that income is gone from Tom's death, his family has to act quickly, and their lifestyle is going to dramatically change. I mean, probably sell the house. If they don't have life insurance in place, probably sell the house. Kids are probably going to have to find their own way to pay for college or just not go to college. Wife's going to have to go to work. And you think maybe you're dramatizing this. We see it. People are having to make those decisions.
Yeah, this is a real life scenario. So as soon as people think it won't happen to them, it unfortunately happens.
One other thing I want to kind of bring up about this situation is Tom works at a corporation. The corporation actually on their benefits package has a life insurance, and it's 3 times his annual salary. So that's $400,000. And you would factor that in to how would that help offset some of the other insurance you might need to fill that gap if something were to happen to Tom. But the downside to those policies, and not to get too in the weeds, the downside to a policy that's at your company, when you leave that company, which people do on average about last I saw was like every 6 years, people change jobs. It may be less than that now. That insurance policy doesn't go with you. It's done. It's you don't get to take it with you.
It's a group policy. So it is a lot cheaper than having an individual policy. But if you don't work there anymore, you don't have the insurance, unless in a very rare cases, there are some companies that offer a policy that's still group, but it's portable. Right. And you can take it with you when you go. But that's very seldom that we see that. We work with a company and have some clients with a company in town that does have a portable policy, but it's so rare. And so that's a good point.
So, but it's not, I would take advantage of it. It's usually pretty inexpensive to get. Take advantage of it most of the time, but don't necessarily just count on that meeting all your needs.
That's the icing on the cake. That's not the cake, is the way I explain it. So that's good. We've got another scenario here that's as we have some clients in this particular situation. So Les, I'll let you take the lead. The asset map, there's a lot more stuff on that picture than the previous scenario. Yeah,
so John and his wife, Jane, are in their mid-50s, and John's a small business owner. Worked a long time, business is somewhat successful, has done a good job with his business, and he's accumulated some significant assets. He's, has a net worth of about $5.2 million. Mm-hmm. So you would think, that he has everything taken care of. If something happened to him or Jane, that, he would have plenty of money to cover the rest of whoever's left behind's life. Mm-hmm. But going through some analysis here, he doesn't have a ton of just money that's liquid in his savings. A lot of his money's tied up in his business. Nice. He's got a business partner, like we were talking about. So if you'll notice on here, he does have a buy-sell policy, as does his business partner, which you can't see in this example. But and he does have $1 million term policy. So you think, he's got $1 million.
Well, the buy-sell, that wouldn't go to that in this scenario. That goes to the company. That goes to the business partner of the company. That doesn't go to his.
That's right. So that goes to help the
business continue to function.
Yeah, his business partner, which is also he wants to take care of if something mm-hmm. happens. So he's got some insurance though. He's got $1 million. His wife has $500,000. But when you look at the analysis on that, because he has a fairly significantly high income from having a successful business, $250,000 a year, and then he's got some other retirement benefits and that kind of thing. If something were to happen to John at age 57 here, to take care of his wife for 10 years and have the transitional income. He also wants to and we see this a lot. He's got a couple kids that are grown, that have grandchildren, and that are starting to have young families, and it's always been a goal of his to leave something to them. So he would like to leave them $500,000 each. When you look at that, he's underfunded. Even with that $1 million policy, he's underfunded by about $4 million, right. Which sounds just like a crazy amount of money. But what we didn't talk about is he's also got debt that he's got to pay off. I mean, he's still got he's still got a mortgage, a small mortgage, and about $200,000 in a mortgage, and then, but really it's to keep that lifestyle for his wife.
To maintain the lifestyle, continue the business, and leave a legacy. And we are taking in our business, every situation's right. unique. So if you're sitting there listening, like, this is crazy. That's not. No, you got to put that person in their shoes, or put that person in Jane's shoes here. To maintain that standard of living is what. I jokingly say that I don't want to, if I'm not here anymore, I don't want to have too much insurance on me because I don't want to finance another man's lifestyle on the beach with my wife, Right. But I do want them to maintain her standard of living, love my family, my kids, my wife, and I want to see that. So in his scenario here, that's a different situation than mm-hmm. the previous one we looked at. And to maintain that standard of living, that's what would be needed. Now, at the same time, as we talked about previously, there may be, depending on politics, a potential estate tax situation in this scenario because
that's exactly right.
You said that his overall net worth right now is 5.2.
Yeah, so that would put about 1.7 million, right?
Yeah, it's proposed 11.7 is right now per individual, and it's currently, and proposed is 3.5, and that's just in today's numbers.
So if his assets don't grow at all, and he passed away today, and if he passed away next year, and the proposed new policy for the real estate tax.
Him and his wife passed away, and it went to the kids.
The kids. Mm-hmm. There would be tax on anything above that 3.5.
That's right. So you're talking about $750,000 possibly in tax.
And it used to be a really high rate.
Yeah, and it's up around 50%. So
Right.
it's a significant amount of money. So you got to think through things.